Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. The conversation these days seems to be completely engulfed by what's happening to yields. And in between, you will hear a piece or two about where the valuations are, and then conversations about liquidity thrown in. The idea is to try and make sense of what each of these moving parts together mean for equities as they trade currently and what they could mean for equities over the course of the next, say, 12 to 24 months. We thought let's pose all of these difficult questions to our guest. He's joining us on BloombergQuint for the first time. Mrinal Singh, CIO and CEO of InCred Asset Management. And Mrinal, great having you. Thanks so much for taking the time out.
Thanks, Neeraj. Thanks for getting me over.
No, the pleasure is ours. So Mrinal, makes sense for us. Let's try and piece this together in 2 or 3 buckets, and let's start off with what the global piece is, because that is undoubtedly impacting the mood of the market and causing volatility as well. How how worried or not worried are you about this whole conversation about inflation and yields and the impact that it has on equities, both global and local?
So, well, inflation obviously matters a lot more to the bond markets, and there is genuine concern the bond markets are showing. If inflation does rise and sustains and becomes stiff, I think the bonds will kind of reflect that in the yield stiffening. They keep looking at the regulators and the policymakers to give them, comfort and direction in that. But then, does it matter to the equity markets? The reality is yes, in terms of at least the fundamental cash flow discounting rates, the risk-free rates do matter. So if we do deviate at some point in the future from the ultra-accommodative stance that most regulators have had or central bankers have had, I think there would be a readjustment on the equity valuations. But then, having said that, we've generally seen that it does not happen in absence of a good economic activity or growth. So, well, again, as an extension to it would be that what we have seen largely up till now is a broader market moving up, and largely everything that has been in the listed space, let's say, or the recipient of the liquidity that has been floating around, maybe it's stimulus, be it the low interest rates, whichever way. Now, going ahead, let's say if we envisage a scenario like what you are articulating, we might have different return streams for different companies or different sectors. Now, and that is where I think a lot of active management of investment comes into play. So I guess there's a good element to it, there is a worrying element to it, and there is a there's a normal element to it. When I say normal, that's part of the cycles. Things there are cycles when the stances are very accommodative. There are cycles when to maintain inflation, the interest rates could move up. The bonds are kind of reflecting that. But to the specific point that will inflation worry the markets, the bond markets definitely yes. The equity markets to a lesser degree again yes. But then to active money manager, that's an opportunity as well.
Yeah, in fact, that was going to be my next question. That if indeed the markets get worried by this whole rhetoric about inflation and yields, and we've seen very recent instances of that, would you use these minor corrections and as opportunities, or would you believe that? And of course, part two of my question would be: would you believe that this has the power to cause a larger correction, or you believe that that would be ruled out? That there could be small instances of the markets getting worried, and that could happen every now and then, but a large correction because of the yields is ruled out.
So well, let's look at the brighter side of things. We are not going to have either inflation or rates being increased by the regulator unless there is solid evidence of let's say growth. Because inflation per se would mean that demand is outstripping supply. Now that's a very good scenario. Well, inflation has to be controlled, wherein we have to increase supply. That also means that there could be capex done to increase supply because demand is exceeding that, and which is good. I mean, I think economy like India would clearly benefit if we have investment to capex. But then we are in this context, we are talking mostly about the Western developed world. I mean, if there is, and history has enough data points around that, if we do see minor corrections, and corrections are part of any market actually, So if we do see corrections, and that's particularly led by, let's say, the developed world, let's say the US or Europe or whatever. I'm not trying to say that it is going to happen anytime soon or whatever. I have views in either ways. But then if it does happen, I think that's a great buying opportunity. Because I think once the concern on corona and related impact on economic activity behind, once we've seen the worst of economic data and economic activity behind, I think there is only one way, and that way is up, and that could potentially go involving, getting right kind of businesses at interesting prices. So corrections are always a great, or dips are always a great time to buy. And most investors, the seasoned ones, the active ones, will be keenly waiting for the right prices, and if I may use the word, pounce on those prices, and make the most for their investors. I think that would be a great opportunity to buy. There's no two ways about it.
Okay. So having settled debate number one in the last 5 minutes, let's talk about the other point. And I see varying opinions on the sell side about the rising commodity prices and the impact they could have on earnings and the degree to which the investor should be worried about these. Now, you would have done at your house your internal assessments about the companies within your portfolios and coverage, or not coverage universe, but portfolios, and what kind of impact can it have? What's your sense, Mrinal? I mean, would these have a large telling impact, or is it difficult to say because we don't know whether the prices will stay high for the foreseeable future? And even if there is an impact, is it a cause for worry, or do you think the markets will be able to digest this?
So commodities, two, three angles. The commodity that really matters to India on a worrying part is actually, let's say, crude. So if crude remains stiff and high, I think it does cause a botheration, because that does destroys the entire scheme of things, particularly on the government balance sheet, and it in a way takes away the disposable income from the larger mass of the consumers. But then if we have a gradual uptake, let's say in agri commodities, I think that's a good thing. Why? Because agri commodities, that's the way we look at it. The agri commodities price going up gradually is actually benefiting the rural producers. So unless it starts spurring the core inflation, a gradual constant increase in agri commodity prices, I look at it very favorably. It creates larger incomes for the rural folks, and it does good to the consumption capability of a large population in India. So if it is going to be agri in a gradual way, I think it is nice, it is good. If it is crude, it is worrying. It impacts the currency, it impacts all kinds of deficits and government's ability to spend, as well as consumers' ability to consume. If it is other base metal commodities, let's say things like iron ore, or something. Iron ore in a way still benefits. Are an exporter as a nation. We are an exporter for iron ore, but then largely it starts reflecting in steel, aluminium, and the base metals. So beyond a point, we start seeing that it starts impacting demand. Now, if we have to invest in infrastructure, I think it is imperative that we have a modest price on the consumption of these things. But then we also see companies which are producers of these, or refiners of these commodities, which benefit. But we've generally seen, if you look at the demand pattern, the demand for base metals is largely governed by the consumption trend for, let's say, China. I mean, in almost all the base metal commodities, China is almost a 50% consumer if you look at the data. So depending upon how the Chinese economy is going to look at consumption pattern on base metals, I think that governs the prices of those commodities. So, I mean, to answer your question, commodities have to be split. In my eyes, at least, we need to split it three ways. Crude, obviously, it worries, and it's not the right kind of increase. Agri commodity in a modest form moving up, I think it's good, as long as it doesn't stroke inflation in a meaningful way. And base metals going up is both good and bad. It is good for some companies, is not so good for some other companies, but largely governed by China. So that's how I look at it. But then it looks like at least the outlook seems to be on the positive trajectory for the prices on all three. Let's see. Hopefully, it should not reach a point where it starts or it stretches the elasticity on the consumption side of all these commodities in particular.
Okay, and I'll revisit this answer in just a moment, but just before we get to specifics, Mrinal, a question on valuations as well, right? Everything is good at a price, and I think there are a number of uh, data points thrown out there, and you can slice and dice data whichever way you want. You would know that, but a number of data points thrown out there which speak about the Nifty current valuations compared to its long-term averages, both on PE and price to book, and the relative valuations that the mid caps and small caps have vis-a-vis the Nifty. I heard you mention at the start of the conversation that the last few days the mid caps and small caps have actually done reasonably okay. What's your sense of how does, I mean, ceteris paribus, everything else remaining constant? What's your sense of what happens to the headline index, even if it doesn't create wealth, but it will be a barometer of the sentiment, and then the broader end of the spectrum? And how are you guys at InCred positioning your portfolios accordingly?
So, well, I'm very clear. I think the next 5 years, at least in the way I see, the index might deviate meaningfully from what potential good stock picking could deliver. We've seen such phases in the past. There is a lot of ETF oriented or index oriented monies which has kind of elevated the broader market ease or price to books, whichever way you want to call it. And I have always looked at index like it's a rear view mirror. It's about the companies which have done well in the past. We are in an era where disruption is happening at a very, very rapid pace. I mean, if I just look around, we might potentially have at least 20% of the companies getting changed in next 2 years in Nifty. I mean, that's the kind of listings that are planned, if I may look. So we are talking about when we look at Nifty. I mean, I don't even want to spend time trying to calculate what is the price to earn and price to book. It is about the past. It doesn't matter much, frankly. It's an index which we need to see, we need to track. The world will continue. But if you ask me, will Nifty look very different in 2 3 years? The answer is a definite is. We have very large businesses waiting to get on to listing, and I think in no time they will be in the index. And we are also talking about very huge disruptions. What the last 1 year has done is clearly made a dent into way consumption and consumer behavior is perceived, and all businesses are trying to adapt to a new way of consumption, a new way of life. The consumers are very clear now, as in there is going to be e-commerce. It is going to be meaningfully bigger. So there is going to be disruption in all kinds of industries which we thought that could never be disrupted. We are talking about electric mobility. We are talking about host of things. So I think we got to look about how the future looks like, which are the businesses and the management which are geared for it, who've got the capability to make it through. It is a crowded space. A lot of these disruptions are more or less certain, but then in terms of timeline, in terms of capability, which many businesses do make it, I think it's a golden period for active money managers lying ahead. An index will just clutter your thought. It will just bound your thought. I think you have to break out of that mental barrier and just look beyond. Look 5 years ahead, and you will see that the world is going to look very different. The sky will be very, very different. So, index it is about the past. I don't think it's worthwhile spending too much time calculating the broader ratios on the index.
Similarly, for the small caps, I'm just trying to figure out that would the sentiment around the broader end of the spectrum be different uh, if indeed the market ends wisdom sees that how compared to averages, compared to many other factors, the mid caps and small caps might be trading at some point of time at a discount, and that just keeps the overall sentiment around that pocket either positive or negative. Do you think that will happen, or again the markets will ignore it largely?
So, well, we are going to see a large amount of businesses graduate from mid cap, largish mid cap to large cap. I mean, that's inevitable. It has always happened. It's going to get accelerated in there. So, well, for an classical investor, the hunting ground or the landscape is actually mid and small cap. There's no two ways about it. That's the place to be in terms of continuing to find potential investments. And this is like what you read in the books. You look at the business, you look at the management, look at the potential of what they are trying to target. And if you get it right in terms of both business and management, I think there is a large amount of returns potentially waiting. Now the disclaimer is the markets will have its own cycle in the meanwhile. The markets will go up, they'll go down, but then eventually the stock prices or the market caps will align to the earnings and the growth. And I think the potential to grow in mid and small cap, and small cap is such a large space now. I mean, if you look at the definition of SEBI, I mean, top
Yeah.
250 stocks, the mid and large cap is over. So I think in at least when I started my career in investing, what used to be mid cap now I think is largely in the small cap domain. So besides the top 250 stocks, everything is small cap, and now that's the hunting ground. That's the place. That is what excites me. And every day I end up, stumbling upon a business which is doing something so interesting, and it makes
Mm-hmm.
me wonder: are we doing justice to, putting our minds to so many entrepreneurs? It is very, very exciting to see. We have so many entrepreneurs, trying to do so many things. I mean, we've got a great future on that space, and there is a lot that will change in the future.
So, Mrinal, before we get into these discussions about themes that could do well, can you tell, without getting into names, of course, because this is not a place for recommending stocks or whatever. So, don't name the businesses, but are there some really exciting things that you see Indian entrepreneurs doing? What is it that really stood out for you in the last 2, 3 months when you heard of a particular segment of a business or a particular thing that a particular entrepreneur is pursuing?
So, well, I keep stumbling upon, maybe it's just me or us. I see a broader term that being used, fintech. Now, fintech is some place that we see a lot of enterprising businesses. So it's not about putting technology to bring loan to you or something of that sort. The backbone, the way consumers want to consume credit, to what access, what speed you can bring things on table. Then we see a lot of interesting businesses happening in the rural space. So we quite upbeat about businesses which are facing rural India. We are upbeat about healthcare. I think healthcare people have just woken up due to the corona incidents that we've had in last 1 year globally. Healthcare is not only about pharma. I mean, even yesterday we had the Quad meeting, and India proposed that we will manufacture vaccines for the world going ahead. So we've emerged as a powerhouse in the healthcare space, particularly pharma, and we have just scratched the let's say the tip of it. I would say. I mean, healthcare is a broader term. I would say we see a lot of scope over there, and things like biomedical waste treatment, things like healthcare. I mean, if I would not be surprised at some point, that hospitals could potentially, or healthcare as a general at least, could be part of infrastructure definition itself. I mean, at the end of it, having hospital beds is infrastructure. I mean, that is what we needed to tackle corona. So we see scope for healthcare. We see a lot of scope for housing, both on the construction side as well as on the lending side, mortgage business around that. So we see utilities as very interesting, very stable incomes, very cash rich. We also see infrastructure as a great place, and technology. So these are places where we clearly see very, very interesting businesses, very good prospects, and very enterprising minds who are trying to do some things very new. Along with, so I will club the financial parts with fintech and say technology and finance combined, something of that sort. And I think that's a great place. I would say rural, utilities, housing, healthcare, infrastructure, technology, very, very good.
What about pockets which are on the throes of potentially making a bit of a U-turn? And I would want to talk about the current buzzing environment in PSUs. They seem to be optically turning a corner in terms of how the government is viewing them, how there is interest in snapping them up should the opportunity arise, and the valuation comfort being there too. Now, again, I heard you mention that valuation is a rearview mirror metric, so to say, but be that as it may, they're not trading at very high valuations. So, are you as a private fund manager thinking of allocating large pools of capital to PSUs at all, or are you shying away?
So we've seen government policies, swing. They've always had the intent of doing disinvestment. Let me be very clear. And something or the other kept on, stopping or making things happen. This time, I think we see a very determined commitment to take it through. And I won't be surprised. At least one or two cases shows go through, and I think it's a step in the right direction. In terms of valuation, there's no denying. A lot of government businesses could be very, very attractively priced, and if they switch hands to something more private and efficient, I think there is a large value unlocking waiting for that to happen, and we obviously would be keen. In a limited way, we would participate. We would like to have our own, picks in that space. Something which is more, I would say, a bit more ESG compliant. Something that has more cash flow orientation, something that potentially could be could be easy to for a private sector to absorb into existing business and add value, something of that sort. So these are things that we look and we do evaluate all the PSU businesses like we do normal businesses, but we do also keep in mind that there is government ownership over there, and then at times things could be highly influenced by what the intent of the government could be, and which might not necessarily, for right or wrong reasons, be economic in nature. So well, that's how we look at it. But then I think we have seen the rigor and commitment to get the disinvestment through is the strongest I've seen in the last 7-10 years, and I'm quite I won't be surprised at least one or two cases should go through, and that will open the gates for a lot of activity in that zone.
Okay. Now, final question. A lot of things look good. The common consensus is that things are looking rosy. Where is it that you are worried? Be it on the market front, and the common answer could be crude or geopolitics, and be it on the thematic front. Are there pockets where you believe, either due to valuation or due to less favoritism or what have you, that they could lag uh, the winners?
So, well, I think the broader valuations are worrying. There's no denying that. Worrying in the sense they are on the stretch side, let's say one standard or two standard deviation ahead of the long-term averages. At least some of it, at least a part of it can be justified by potential growth in earnings that can come across, but not all of it might be justified. I also worry there could be swings in the market led by external risk, something that could emerge from the Western or the developed world that can happen. But broadly, I also think that too much focus, too much monies, too much talk happens around the larger businesses. I think the reality is that on the smaller side is where real action is happening. And I guess there is a lot of effort and reward waiting over there. Besides that, I would say things on the Indian economy could potentially look better. We might get interesting opportunities if there are corrections along the way for a variety of reasons, and we might choose to pick, interesting businesses. It is a time to, do good work and wait for the prices, or maybe if you think the current prices are good, left it on.
Yeah, by the way, I believe you guys are doing some very interesting work. I'd seen a presentation from one of your colleagues, Aditya Khemka, a couple of months back or 3 months back on healthcare. So that's interesting too. Would you want to end this conversation, Mrinal, with telling us what you're doing at InCred? Because you are a new AMC in that sense. What is the AUM? What is it that you guys are trying to do out there? Can you talk a bit about that?
So we've just started our journey, and we are in the business of alternates as of now. So we are, having a license for alternate investment funds and PMSs. So we are soliciting money from our clients into differentiated strategies and spaces where we think there is potential to do well in terms of investment returns is substantial, and we want to add value to our clientele in a unique way, in a more committed way, and our decision making and endeavor are aligned to our customers fully. So it's a journey that we've begun. We have a vision of being amongst the most respected asset management companies in India, and it's just a few steps that we've taken in that direction, and we hope we get there as fast and as soon as we can.
Okay, interesting. Mrinal, all the best for that. Thanks so much. It was lovely talking to you, and look forward to have you more often on the forum.
Thank you. Thanks, Niraj.
And viewers, thanks for tuning into this edition of Talking Point.